Hi, everyone, and thanks for joining us for today's CFRA webinar, Consumer Staples and the Future of Meat Production. The presenters today will be myself, Garrett Nelson, and Arun Sundaram. My coverage spans both the consumer staples and consumer discretionary sectors, and in consumer staples includes beverages, tobacco, and hypermarkets and supercenters, while Arun covers most of the other industries within consumer staples, such as food retailers and distributors, agricultural products, household products, and the largest industry in the sector in terms of number of companies, and the one he will be covering today, packaged food and meat companies. Here's our agenda today on slide 3. First, I'm going to provide an update on consumer fundamentals and our outlook for the consumer staples sector. Then I'll hand it off to Arun for a look at how COVID-19 is affecting meat processors and the various ripple effects the plant shutdowns are having. Then Arun will discuss plant-based meat trends, which is a very rapidly growing market. And then he'll transition to another fascinating topic and another area with huge growth potential, which is lab-based meat. Then we'll end with some winners and losers in meat processing. And hopefully we'll have some time for Q&A at the end, and you can submit your questions at any time through the chat function. Our legacy goes back more than 90 years since S&P began publishing research on equities way back in 1927. And this slide shows some of the significant landmarks in our growth over the last few decades to get us where we are today, which is one of the world's largest independent research firms. CFRA blends fundamental equity with forensic accounting research techniques, as shown on slide 5. Our research covers all 11 sectors and 68 industries on a qualitative basis. We cover more than 1,500 companies globally, and on a quantitative basis, we cover over 25,000 companies. I would also highlight that CFRA's acquisition of First Bridge Data last year greatly expanded our offerings in the ETF and mutual fund category. One important distinguishing factor about CFRA is our independence. Research is all we do, as shown on this slide. CFRA does not manage money or make trades and does not have an asset management arm. And so with that, without further ado, let's go ahead and move on to consumer staples and our consumer staples sector outlook. And one thing that's important to understand about the US economy that makes it different from a lot of other major economies around the world is that it's so consumption driven. The pie chart on the left of this slide shows the breakdown of US real GDP last year between its 4 different components, which are C plus I plus G plus X minus M. And as we all learn in macroeconomics, that's the formula for GDP, which is consumption plus investment plus government spending plus net exports. And US real GDP last year was about $19 trillion, but the consumption part of that equation is about 70% of GDP, as shown here. And we feel that the US economy is really at a critical crossroads at this point in time, with consumers having really pulled back on spending due to the pandemic. And we think the rebound in US GDP will largely depend on consumer confidence and the overall health of the consumer going forward. And because the US economy is by far the largest in the world, it's about 50% larger than the next largest economy, which is China. The US consumer, to a large extent, really holds the keys not only to a US economic recovery, but to a broader global recovery. And the pie chart on the right shows the breakdown of that $13.3 trillion of personal consumption last year. And that breakdown was about 64% services, 23% non-durable goods, and 13% durable goods. So this is why you often hear economists talk about the US economy being so service driven. And that's because industries such as healthcare, large portions of technology, banking, legal, those industries all fall under that umbrella of services. Next, looking at some of the key indicators of US consumer health, GDP growth and employment, obviously both have taken a huge hit recently, On GDP growth for the second quarter, many estimates are in the range of a 30 to 50% decline. And in fact, if you look at the Fed's own, the Atlanta Fed's GDP Now forecasting tool, that's currently forecasting about a 45% drop in GDP for the second quarter. And that's way down from the 5% drop that we saw in the first quarter. And the chart on the right here shows the unemployment rate, which spiked to 14.7% in April. That was up from a 5-decade low of just 3.5% 2 months earlier, of course, because of the shutdowns related to the coronavirus. And then what we saw in May was the unemployment rate unexpectedly fell from 14.7 to 13.3%. And economists were estimating the consensus for May was a 19.8% unemployment rate. So this was way below expectations, and it was largely due to furloughed workers, many of whom in the hospitality industry being called back to work. This next slide shows the weekly initial jobless claims, which has become a very highly anticipated weekly data release when that comes out every Thursday at 8:30 a.m. Eastern. And what it shows is that weekly unemployment filings hit a record high of 6.9 million. That was in the week ending March 29th. And the number of filings has fallen each week now. So that's 12 straight weeks it's declined to the number that we just got a few hours ago, which was 1.48 million in the most recent week. And the chart on the right essentially tells the same story of massive job losses starting in late March, and really a catastrophic loss in April, with the greatest loss of jobs occurring in leisure and hospitality. But then it also shows the unexpected increase in May, an increase of about 2.5 million, reflecting, it also reflects the decline in the unemployment rate shown on the last slide. Next, looking at consumer confidence on slide 11, consumer confidence bottomed in April. It rebounded modestly in May and had a much larger rebound earlier this month when the June number came out. And the survey showed that the driver was an improvement in the outlook for personal finances and U.S. economic prospects. And we think that really reflects a few things. People having received their stimulus checks and spending a lot of that money, the reopening of a lot of businesses, many states reopening, and in the rebound in the stock market and also the housing market. The stock market bottomed back on March 23rd and has had a huge bounce, obviously, since then. And the housing market is showing signs of stabilization. Interestingly, the economic optimism index has not rebounded yet, and the June reading was actually the lowest since late 2016. It came in at 47, which is below the critical 50 level, which separates pessimism from optimism. Here on slide 12 are our current outlooks for the two consumer sectors, consumer staples and consumer discretionary. Our recommended weighting right now is market weight on both sectors. Obviously, consumer discretionary names tend to be higher growth. They're more cyclical, but they also have lower dividend yields. They're higher beta names, and they have higher leverage ratios on average. And that's the group that's really had an enormous rebound since the stock market bottomed in mid to late March. Conversely, consumer staples tend to be larger companies on average. They tend to be more defensive, more value-oriented. They pay more generous dividends. They have lower betas and have lower leverage ratios on average. And consumer staples really outperformed in the first few weeks of March, but since then, the discretionary names have really had all the momentum. And the S&P 500, posted the largest rally in history in the shortest period of time, since that bottom on March 23rd. So what we've seen so far is that it's certainly been a V-shaped recovery as far as the stock market goes. As far as key metrics to understanding the consumer sectors, I'll have a slide or two on each of these bullet points coming up next. We'll take a look at each of these metrics and where consumer staples stacks up and the implications for the consumer staples sector. But we think these are the important metrics for investors to understand when talking about the consumer staples sector. Earning stability, performance and valuation, beta, dividend yield, leverage, and also historic share price performance. We'll look back at how the sector performed during each of the last two recessions, 2008 and the 2001-2002 timeframe, and we'll also look at how each sub-industry performed during those periods, including the one that Arun will be covering today, packaged food and meat. This next slide shows that consumer staples has really underperformed both the broader market and consumer discretionary sector over the last decade, and you can see the underperformance is pretty astonishing. Consumer discretionary has risen about 300% over the last decade, while consumer staples names have risen about 120%, which lags the S&P Composite 1500's performance. And that, of course, is because we've experienced the longest bull market in history, which has lasted, during this entire period and just came to an end a few months ago. Next, looking at valuation, the consumer staples sector is currently trading at a discount to the S&P of about 11%, although consumer staples are trading at a premium to its own 10-year historic median PE multiple of about 13%. And as you can see, consumer staples stocks are trading at their highest PE multiple in a decade on consensus estimates over the next 12 months. So this is looking at EPS estimates over the next 12-month period. So our point here is that consumer staples names certainly appear much more reasonably valued at the moment. Next, let's look at the betas and dividend yields of the various sub-industries within consumer staples. And we think beta is an important metric for understanding how the equities have performed historically and might perform in the future. Most of you on the call are probably familiar with the concept of beta, but if not, it's a measure of a stock's volatility in relation to the overall market. So, for example, the broader market, the S&P 500, by definition, has a beta of 1. And a stock that historically has moved up or down by twice the percentage of the S&P has a beta of 2. And conversely, a stock that has moved up or down by half as much as the overall market has a beta of 0.5. So consumer staples is a sector that's very low beta. The average beta is 0.66, as you can see here. And the packaged food and meat sub-industry actually has an even lower beta. The average beta is 0.5. The average beta of a consumer discretionary stock, by the way, is 1.36. So it's more than double the beta of a consumer staples name. And on the right, the average dividend yield of consumer staples is currently about 2.9%, which is about 80 basis points higher than the S&P 500's average yield of 2.1%. This next slide shows leverage ratios. The key point is that consumer staples names tend to have lower leverage ratios, both in terms of net debt to EBITDA and net debt to cap levels. And then if you look at the next slide, this is how consumer staples performed during each of the last two recessions. And as one would expect, due to their low beta and more defensive nature, they outperformed the S&P by a wide margin during both recessions. And if you look at the 2001-2002 time frame, the outperformance of consumer staples was very extraordinary, up about 110% during that 24-month period versus a 33% decline for the S&P 500. And as you can see, packaged food and meat sub-industry had performed very well during both of these periods. And next slide, before handing off to Arun, well, CFRA has a market weight rating on consumer staples. The packaged food and meat sub-industry is a sub-industry within the sector that we do have a positive outlook on. So this slide shows how packaged food and meat companies stack up on the various metrics that we just discussed. As I mentioned, the beta is below the sector average. The dividend yield is solid. Packaged food and meat companies have an average dividend yield of 2.6%. It is slightly below the sector average, but it's well above the S&P's average yield. Their leverage is about average with the sector mean. And then performance-wise, if you look back at the 2008 recession, it was the third best performing sub-industry in the sector, and it was the fourth best performing in 2001, 2002. And the only sub-industry that posted better performance overall was household products during each of the last two recessions. So with that, I will hand it off to Arun. Thanks very much.
Awesome. Thanks, Garrett. So I'm excited to talk about a few things today. First, I'm going to go through the impact of COVID-19 and the impact it has on conventional meat processors, and explain to you why we think the challenges facing the meat processing industry right now are all short-term, and that the longer-term outlook still looks very promising. And then I'm excited to talk about two emerging trends in the protein space, that is plant-based meat and lab-based meat. These new industries not only have the potential to reshape how we consume meat in the future, but we also think it may impact how we tackle other challenges our world is facing, such as overpopulation, climate change, healthcare concerns. Okay, so moving on to slide 21. Over the past few months, over 20 US meat processing plants have temporarily closed down at some point due to COVID-19. And while this was happening, dozens of additional plants were operating on a limited capacity. And this is because of things like worker absenteeism and lower demand from food service or restaurant customers, and also because of enhanced safety measures implemented in the plants, such as social distancing and thorough cleanings. So livestock farmers, we think, have been hit particularly hard because they were facing challenges prior to these shutdowns, such as lower demand for meat from food service customers. And now they're incurring more costs to keep their livestock on the fields because they need to keep it longer. And then they're also getting paid less when they do end up selling their livestock to these processing plants. But things really started to change on May 8th when President Trump signed an executive order to deem meat and poultry processing plants as essential businesses. Since then, there's been less pushback from state and local authorities to close plants where coronavirus outbreaks were popping up. And although it's great that capacity is back up and Americans are able to purchase meat at the grocery store, the bad news is that coronavirus outbreaks are still occurring, and worker safety issues are still not fully addressed. And I think this could be a challenge that the industry will face until, unfortunately, a vaccine is available. But the silver lining here is that for meat processors, that during these troubling months, processing margins were at record highs, meaning the cost to purchase livestock ready for slaughter were at lows, while wholesale prices for meat were on the rise. And this helped offset higher costs incurred from COVID-19. And I'll get to this in a little bit more detail in the subsequent slides. On slide 22, we've illustrated the cadence of historical and expected future US meat production rates. As you can see on both the pork and beef charts, the USDA is expecting a V-shaped recovery in meat production levels. After a record Q1 production, meat production is expected to fall sharply in Q2 before swiftly recovering in Q3. And the big takeaway here is that operations are normalizing, and normalizing rather swiftly. On the next slide, we've illustrated just how high beef and pork wholesale prices surged back in May May and April and May, when manufacturing plants were closing down left and right due to the virus. And then when plants started opening back up in May, wholesale prices took a dramatic turn downward and are now below historical averages. We believe prices will revert back to the historical averages in the coming months as demand improves with restaurants reopening, and also because cold storage levels are now depleted, so there's less meat in reserves. And we'll get to this in a little bit more detail in the next few slides. But the point to be made here is that processing margins were at record highs back in April and May during these plant shutdowns, which helped offset the higher costs incurred due to COVID-19. And now things are looking like they're rapidly normalizing. And on slide 24, this slide depicts the cost side of the picture. On the cost side, the price to purchase hogs and cattle ready for slaughter are expected to be well below historical averages for the most of 2020. This should be a tailwind for meat processors, since direct raw material costs should be favorable for the rest of the year. Unfortunately, the persons negatively impacted by this dynamic are the farmers, who not only have to incur more costs to keep livestock on the field, but again, they're also getting paid less to get them off the field and into the processing plants. So moving on to slide 25, this slide illustrates the amount of meat currently sitting in these cold storage reserves. Cold storage reserves essentially means how much excess processed meat is sitting in large frozen chambers across the United States. So when plants were shutting down in April and May, these processors, they turned to cold storage reserves to meet customer demand. And you can see this took a larger toll on pork reserves than beef. Pork reserves were down 26% in May compared to the prior year. And overall, red meat reserves were down 13% from last year. But before the month of May, meat reserves were either at or above historical averages. And that is why we never believed Americans would face a major meat shortage at the grocery stores. But going forward, we expect reserves to gradually increase since capacity is rapidly improving among meat processors. But now the major risk is if a second wave of COVID-19 results in additional plant closures, because if this happens, we don't have as much reserves that we did in the past to meet customer demand. So next slide, I want to talk about some of the longer term opportunities that meat processors could be facing. So there's currently a massive global protein shortage due to a disease called African swine fever. So African swine fever, or also referred to as ASF, is a severe viral disease of pigs that can spread very rapidly among pig herds. The most recent outbreak began in August 2018 in China, and to put it quite frankly, it completely devastated China's hog population. And this is very problematic because the Chinese are the largest consumers of pork before this disease occurred, and then they're also the largest producers of pork. And as you can see on the chart to the left, China's swine population is expected to be down 27% in 2020. The chart in the middle shows that China's pork production is expected to be down 20% in 2020 after being down 21% in 2019. So this massive protein shortfall is resulting in China looking to oversee markets for protein. And so the chart on the right illustrates just how much more pork China has been importing. In 2020, China is expected to import 57% more pork year over year. And this comes after China imported 68% more pork in 2019. This is a significant opportunity for meat processors, especially because trade barriers and tariffs are now reduced. So on the next slide, we've illustrated just how much more pork China is importing from the United States. In the first 3 months of 2020, the United States' share of China's total pork imports was 18%. So last year at the same time was 7%. So that's an 11-point market share gain. And there still could be room to grow because the EU still holds the top position with a 58% market share. Also, Brazil, who owns about a 10% market share, is seeing surging coronavirus cases right now, which could negatively impact their export business and give more opportunities for U.S. meat exports. Overall, there's going to be more export opportunities for for U.S. meat processors over the coming years, not just exports to China, but many other countries around the world because of recent trade agreements signed. So this brings me to slide 28, which summarizes the 3 major trade agreements that were signed over the past year, all of which should make U.S. protein more competitive in the world markets. The first one, and the biggest one, is phase 1 of the U.S.-China trade deal, which was signed in January 2020. This agreement allowed the U.S. to resume shipping poultry to China, which was banned since 2014. Prior to the 2014 ban, the U.S. was shipping about $500 million worth of chicken to China, we now think the US could bring in almost $2 billion in annual poultry sales from China. So the second major trade agreement over the past year is the US-Japan trade agreement. Now, this agreement is important for US beef since Japan is the largest market for US beef exports. In Q1 2020, the US shipped 17% more beef to Japan than it did in Q1 2019. And now 30% of all of our beef exports go to Japan. And then last but not least, the USMCA was signed in January 2020 to modernize the 25-year-old NAFTA. The International Trade Commission expects full implementation of the USMCA to increase US agricultural exports to the world by $2.2 billion. So moving on to the next slide, due to these trade agreements and the result of African swine fever, US meat and poultry exports surged in the second half of 2019. You can see on this chart, Q1 2020 was a record quarter for US pork exports, with pork exports increasing 40%, US beef exports increasing by 10%, and US chicken exports increasing by 8%. Now, things are expected to slow down in Q2 due to the meat processing constraints that we previously noted about, but things are expected to improve after Q2 and recover for the most part by the end of 2020. All right, so what does all this mean for US meat processors, meat and poultry processors? On the next slide, just to wrap things up, we listed some positive and negatives. On the positive side, processing margins were at record highs when plants were closing down in April and May. Now, processing margins have begun to normalize since capacity is improving as both plants and local economies reopen. The USDA believes we're now at about 95% capacity levels, which is much better than the 50 to 75% levels we experienced a few months ago. And then over the long term, there will only be greater demand for meat due to a growing world population and a rising middle class population. In fact, the FAO expects global meat demand to nearly double by 2050. And then lastly, over the medium term, African swine fever should be a major growth catalyst, which will support US protein processors. The right side of this slide summarizes some of the challenges the industry is facing, including worker safety issues, the threat of a second coronavirus wave this fall or winter, or whether costs could permanently be higher as a result of COVID-19. And then the last bullet point on the slide, I wanted to take a second to talk about some recent developments in a price fixing investigation that was recently conducted by the DOJ. So for the past few years, the DOJ has been investigating meat processors on potential price fixing allegations made by suppliers and customers. So things were pretty quiet until a few weeks ago when a federal grand jury formally indicted the CEO of one major poultry processing company, Pilgrim's Pride Corporation, on price fixing charges. So these are the first charges to be brought in this ongoing investigation. So there is a chance that more companies or executives could be charged in the future. All right, so now I want to get into something that I think is a little more interesting and many of you may be more excited to hear about, and that's the plant-based meat industry. So we estimate the global plant-based meat industry reaching $100 billion by 2030. We derived this estimate using a top-down approach, beginning with the current value of the global conventional meat market, which is estimated to be about $1.4 trillion. We estimated that the conventional meat market will grow by 1.5% a year, which is what the FAO projects over the next decade, which gets you to a global meat market size of 1.65 trillion by 2030. Then we estimate that the plant-based meat market will tap into 10% of the entire meat industry. This 10% penetration rate is our estimate, and it's based on the penetration rate of the plant-based milk industry, which is about 14%. We'll get into this in a little bit more detail on a subsequent slide as well. And lastly, we have to estimate what percentage of animal meat may never get replicated with a plant-based meat option, because there are some inherent limitations when using only plant-based materials. For example, the plant-based meat industry may never be able to replicate T-bone steaks. That's just one example. So far, the industry only has had major success in replicating ground meat, like ground beef and ground sausage. So we use 60% in this estimate but this could be conservative because many industry participants, including Beyond Meat, think that they'll be able to address the entire meat industry. So this is probably our largest variable at the moment driving our projections. So onto slide 33, what is plant-based meat? Well, it's meat designed to emulate the look, taste, and texture of conventional meat, but only use plants as the main raw material. So these products even bleed like traditional meat while you're cooking it. companies in the space they typically use pea protein or soy protein as the main raw material in these products. And then they use other additives like beet extract or soy like hemoglobin to get these products to quote unquote bleed like conventional meat. It's still debated whether these products are truly healthier than your conventional meat products, but by the most part, people do consider plant-based meat as a healthier alternative to conventional meat. However, most participants in the industry are not yet satisfied with the nutritional profile, and they're working rapidly to improve it before they lose too many customers. So the products that you see on the shelves today will likely not be the same products you'll see on the shelves 6 months from today or even a year from today. And then lastly, the target consumers for this industry are who we call flexitarians, people defined as vegetarians or vegans, but they occasionally do eat a meat in their diets. And I think this is the single reason why there's so much hype over this industry. Instead of just targeting meat eaters or vegetarians, the industry is trying to tap into both bases, which significantly increases the market potential. So why are people purchasing plant-based meat alternatives? Well, the primary reason is they want to eat healthier, which I've shown on the next slide here, is they want to eat healthier, but they want to enjoy the taste of your traditional meat. The American Heart Association states that there is a 40% reduced risk of developing heart failure if a plant-based diet is mostly consumed. And research has shown that red meat can clog arteries and increase the risk of heart disease. So a plant-based meat alternative could be a great substitute for people at higher risk of developing heart disease. And then regarding climate change, obviously there aren't livestock needed to graze farmlands in the plant-based meat industry, which is a major benefit because livestock take up a lot of agricultural land, consume a lot of fresh water, and they do emit a sizable amount of greenhouse gas emissions. You can see on the pie charts to the left on this slide, I think the stat that took me by surprise the most is that livestock contribute to about 20% of all human-induced greenhouse gas emissions. I never thought it was this high, but I guess livestock emit a lot of methane from their waste. And then lastly, regarding animal welfare, we rear about 70 billion farm animals each year for food, most of which occur or come from factory farms. The Science Institute estimates that 99% of US farm animals live in factory farms. Factory farms are a reason why infectious disease outbreaks are still occurring at an alarming rate. I'll get into this as well in a subsequent slide. On slide 35, what demographics are purchasing these plant-based meat alternatives? Well, we've already learned that it's mostly people defined as flexitarians, meaning partial vegetarians. But if we break it down even further, you can see that plant-based meat is more popular among younger generations, upper income households, and consumers without children. This is important because the plant-based meat industry could accelerate as the younger generations become a larger portion of the US workforce. And while especially millennials, because millennials now make up the largest portion of the US workforce, and the Gen Z population is just beginning to enter the workforce. On slide 36, we've illustrated just how fast the plant-based meat market has grown in the United States specifically. In 2017, the industry was valued at about $800 million. And then fast forward to today, it's now valued at about $1.2 billion, which represents a 21% compounded annual growth rate. And just to give everyone context, the conventional meat industry is growing at roughly 1% to 2% each year. And then on slide 37, this is an interesting slide because it uses the plant-based milk industry as an analogy for the market potential of the plant-based meat industry. So the plant-based milk industry is roughly a $2 billion retail market. And then the entire retail dairy milk industry is about $14.4 billion. So $2 billion out of $14.4 billion is roughly a 14% penetration rate. Now, if we take this penetration rate and apply it to the entire US retail meat industry, which is estimated to be at about $95 billion, the plant-based meat retail market in the US could theoretically reach $13 billion. So it's currently valued at about $1.1 billion. So there's about $12 billion of growth left. Now, this is an imperfect analogy because, I mean, there are dietary reasons for consuming plant-based milk that doesn't apply to plant-based meat. So this can drive the penetration rate down. But at the same time, the plant-based milk industry isn't trying to imitate the taste of dairy milk or lower its price to be in line with dairy milk. So this could drive the penetration rate for plant-based meat even higher than 14% in our view. Regardless, this is a good analogy to frame the potential size of the industry. And this is also how Beyond Meat estimates the market potential for its US retail sales. On the next slide, we have three factors that we think are influencing the plant-based meat adoption rate. And these are taste, price, and availability. Taste is arguably the most important one because no one's going to buy this stuff if the taste is compromised. And this includes getting the texture right and also improving the nutritional profile of these products. The second factor, price, is also very important. The eventual goal of the plant-based meat industry is to achieve price parity with conventional meat. It hasn't got there yet, but it's getting closer and closer. In fact, just a few weeks ago, Beyond Meat announced its most value pack ever for this summer's grilling season, a 10-pack for $16, which makes each patty $1.60. And by our estimates, this is the most value pack on the market, and it was probably introduced in preparation for a prolonged recession. And then lastly, on availability, the best way to generate more trial for a relatively new product is to have the product in more places and for more people to try. In 2019, the number of distribution points for the plant-based meat industry increased 16% to 25,000 points. Between 2017 and 2019, the number of restaurants serving plant-based meat spiked over 25%. So I think if the industry can get the price, taste, and availability right, then they'll hit the holy grail. And that's when this industry could really start to explode. All right, the last slide I have on the plant-based meat industry is competition. This is probably the most important slide because this shows the competition in the space, which is heating up. And everyone probably knows about the pure play companies like Beyond Meat and Impossible Foods, but you may not be aware of the larger packaged food companies entering the space, along with competition from international companies, private label, and even conventional meat companies like Tyson Foods, Smithfield, JBS, etc. The number of new players entering this space over the past few years is one of the reasons I think this industry is no longer a fad. It's real, and the movement is happening. So 2019 was a monumental year for the plant-based meat industry. It's probably the most successful year by far. And I think 2020 and 2021 will be very important years, since it'll be interesting to see how the industry grows and responds to challenges through a recession. All right, so now something that I assume many people are less familiar with than the plant-based meat industry, and that's lab-based meat. So what is lab-based meat? Well, it's a new way to produce actual meat, not meat substitutes like plant-based meat, like the plant-based meat industry. It's made using animal cells from livestock or poultry and growing these cells into muscle tissue in a controlled lab-based setting. People often refer to this type of meat as clean meat or cultured meat. So theoretically, you shouldn't be able to distinguish lab-based meat from animal meat because both are the same at the molecular level. Now, the industry is also working on getting the taste and look right, but at least they're beginning with a much easier base since they're using actual animal cells to create meat. The plant-based meat industry has had a much tougher time in getting the taste and texture right because they're using pea or soy protein as their base. One of the reasons why we're very bullish on this relatively new industry is that it's much safer and more sustainable than the conventional way we harvest meat. Lab-based meat is produced in a sterile, controlled environment, so the risk of bacterial contamination is very low. And lastly, the last bullet point on the slide is a very interesting stat. This stat is from a company called Mosa Meat. It's a lab-based startup based in the Netherlands who actually created the first lab-based meat hamburger. So they estimate that one cell sample can produce more than 20,000 pounds of cultured meat, meaning you would only need 150 cows to satisfy the current global beef demand. And I don't know if this estimate is necessarily precise, but the point here is that we wouldn't need the over 1 billion livestock we currently have to produce meat. So how is lab-based meat made? We put together this slide right here to give you a very high level on the process of creating cultured meat. This is a kindergarten level diagram because there's obviously a lot more that goes on in making this stuff, but I thought it would give everyone at least a sense of the process. So you start with a small right-sized biopsy that you get from an animal, and then you also combine these cells with nutrients in a liquid medium, and then these animal cells are placed in a bioreactor where the nutrients in the cells are combined, and then after a period of time, meat grows and you can harvest it. So again, this is a very, very high level on how it is made, and I'll get to a little more detail on some of the challenges that the industry is facing on the next slide. So before I get into that, we think 2020 could be the year for lab-based meat, And we can start to see lab-based meat in the market as early as the end of 2020 or early 2021. And this is because the industry is now more relevant than ever before in our view. And it's because the COVID-19 pandemic has probably accelerated the progression of this industry. And as more infectious disease outbreaks occur, there's more reason for this alternative method of meat production to enter the market. So this is an interesting stat right here. Did you know that 75% of new infectious disease outbreaks in the past decade are zoonotic, meaning the disease was transmitted from animals to humans? So some examples are West Nile, SARS, and then now COVID-19. These diseases occurred because humans either directly or indirectly came into contact with an animal infected by the virus. And then another reason why we believe the lab-based meat industry could soon go mainstream is because traditional large-scale animal farming may not be enough to meet global meat demand by 2050. So natural resource constraints inhibit the ability to scale conventional meat production methods in a safe and hygienic manner. And the unfortunate truth in factory farming is that animal welfare measures are usually reduced to a minimal standard or actually not enforced at all, and particularly in many emerging economies, which ultimately impacts our health and the global economy, as we all are way too familiar with by now from the coronavirus. And then we estimate about $330 million has been invested in the lab-based meat industry to date, and over $200 million has been raised during these past 6 months. And this is almost all due to the largest company in this industry named Memphis Meats. So earlier this year, Memphis Meats closed on a $161 million Series B funding. And this round of funding was the largest ever in the industry. And some notable investors are Bill Gates, Richard Branson, and also major companies like Cargill and Tyson Foods. So lastly, getting to the two major hurdles that I think are limiting the industry's ability to introduce these products to the mass market, and that's regulatory issues and the high cost of production. On the regulatory side, the major issue is on labeling, as conventional meat processing company associations have argued that products not derived from animals shouldn't be labeled as meat or beef on the packaging. And over 20 states have now passed legislation to make it illegal for products derived from plants or labs to use the word meat on the labels. And then the other challenge I mentioned is the high cost of production. However, we think this could all change with Memphis Meat's latest round of funding, which will allow them to scale their production. A few years ago, I believe Memphis Meats estimated it cost them over $2,000 just to produce 1 pound of chicken meat. And then another company in the space, Future Meat Technologies, they estimated it cost them $150 per pound to produce lab-based chicken, and then $200 per pound to produce lab-based beef. I mean, these costs are obviously very high and a major barrier in introducing these products to the market. But you have to remember that these products are still being produced at a very small scale. So as scale grows, the cost of production should fall. So the next slide, I just wanted to show the two top companies in the space in our view, and that's Memphis Meats and Future Meat Technologies. So Memphis Meats is a US-based company based in California. Like I said earlier, they've raised the most amount of money in this space, over $180 million, and just $161 million was raised this January. And then the other company, Future Meat Technologies, this is an Israeli company, and they've raised over $16 million so far. But one interesting note is investors for both Memphis Meats and Future Meat Technologies includes Tyson Foods, one of the largest conventional meat processors in the United States. All right, so next, I'm going to be talking about some winners and losers in this space. And the first one is Tyson Foods. We have 5 stars, strong buy opinion on shares of Tyson Foods. And this is because our long-term outlook is positive. We believe the challenges that Tyson is facing right now from plant shutdowns will be short-lived since, as I mentioned in the previous slides, operations are beginning to normalize rather swiftly. Food service demand is improving as local economies reopen, especially quick service restaurants, which make up a large portion of Tyson's overall food service sales. And then over the longer term, such as the next 3 to 5 years, we think there's several reasons to be bullish. For one, African swine fever, as I mentioned before, has shocked the global protein supply chain. And we think companies like Tyson, with its size, scale, and expertise, will be able to see significant growth in the export market in the coming years. And then the recent trade agreements signed by the United States and various other countries, including China, Japan, Mexico, and Canada, should further support U.S. protein and make it more competitive in the world markets. And then lastly, we like Tyson because although they are one of the largest conventional meat processors in the world, we believe that they have embraced this alternative meat movement. Tyson has invested in several plant-based and lab-based meat companies over the past several years. And then last year, Tyson launched its own alternative meat product, and we believe that they'll launch more this upcoming year and in 2021. On slide 47, we've included a graph illustrating just how much Tyson has underperformed the market and the industry over the last year. During February and March, during the large market sell-off, we think Tyson shares were oversold, so we reiterated our strong buy opinion then. And now our 12-month target on shares of Tyson is $75, which is 12 times our fiscal year 21 EPS estimate, and it represents more than 20% upside from today's share price. And on slide 48, we've broken down the beef, pork, and chicken industry by market share to give everyone a sense of how concentrated some industries are and who are the major players, since we believe all protein processors could face tailwinds over the next few years. You can see that the beef and chicken industries are very concentrated, while the pork industry is a bit more fragmented. And of all these names, we cover Tyson Foods, Pilgrim's Pride Corporation, which is a chicken processor, and then Sanderson Farms, which is another chicken processor. We have a 4 stars buy opinion on Pilgrim's Pride and a 3 stars hold opinion on Sanderson Farms. We believe Pilgrim's Pride will benefit more than Sanderson Farms from the reopened poultry trade with China, as well as other export opportunities, since Pilgrim Pride is majority owned by a company called JBS, which is the largest meat processing company in the world. It's a Brazilian-based company, and we think this gives Pilgrim Pride strong ties to Chinese distributors. And then now moving on to alternative meat companies on slide 49, the most popular one by far is Beyond Meat. So although we believe Beyond Meat is a great company and they may reshape how we view meat in the future, we believe its stock has been excessively rewarded from the dynamic playing out in this conventional meat industry over the past few months. So as a result, in May, we downgraded shares of Beyond to a sell from a hold. Our analysis indicates that conventional meat processors are recovering rather quickly, so there will be a low chance for a meat shortage in 2020, in our view. And then furthermore, competition in the alternative meat space is getting fiercer by the week. And as I mentioned previously, Impossible Foods has been gaining traction in the retail arena and also looking to expand into China by the end of 2020. So our 12-month target on Beyond Meat is $95, which reflects nearly 40% downside from its current price today. And on slide 50, we've included all the winners and losers among the packaged foods industry as it relates to competing in the alternate meat space. The companies on the left, which are Conagra Brands, Kellogg Company, and Nestle, we think are winners in the alternative meat space, while the companies on the right, which are Kraft Heinz, Campbell Soup, General Mills, and J.M. Schmucker, we think are losers in the alternative meat industry, either because of weak products or investments in the space, or because they haven't invested in this movement at all. But to sum it up, I think these seven major packaged food companies are the ones to keep a close eye on. Everyone knows about Beyond Meat and Impossible Foods, but at the end of the day, we think larger packaged food and meat companies with the size and scale advantage will end up as the market share leader in the race to create healthier and sustainable meat. And then with that, we've concluded our presentation, and we'll be delighted to take any questions.
Great, thanks, Arun. If you could just give us a second to compile the list of questions. We have several good questions that have come in. Okay, Arun, the first question is, what are plant-based companies doing in preparation for a prolonged recession? And does the recession negatively impact the progression of either the plant-based or lab-based industries?
Yeah. That's a good question. So prior to the COVID-19 pandemic and this recession, we were a bit hesitant on the progression of the plant-based meat industry specifically, since we were at the later stage of the economic cycle, and even though we believe the plant-based meat industry will be more negatively impacted than other CP industries during a recession, because we thought their products are considered more discretionary in nature, given that they're priced at a premium over its conventional counterparts. Now that we are in a recession, our thesis still holds. However, we believe the plant-based meat industry is taking several steps to adapt to this new environment. So for one, companies like Impossible Foods and Beyond Meat, they're introducing more value packs during the soft economic environment, and they're also offering very aggressive pricing to promote and generate consumer trial. So like I said earlier, Beyond Meat, they just recently offered their most value pack to date, which is a 10-pack for $16. And even though this product is only available for a limited time, this can help them generate trial during these uncertain times. And then it also helps Beyond Meat eventually realize its goal of achieving price parity with conventional meat. But one downside I do see to this is how much of a sacrifice is being made to taste and quality. Price is going down, but has taste and quality been compromised? This latest product from Beyond Meat is a frozen product, and I was surprised that they returned to the frozen foods aisle, because it seemed to me that they were more interested in competing right next to the refrigerated meat. So it'll be interesting to see in the coming months how this product performs, or if there'll be any more value packs in the future.
Okay, here's one for me. You've highlighted several compelling traits of consumer staples names in this environment. It seems like a more defensive stance is justified given the resurgence in coronavirus cases. Are there specific industries within consumer staples that you think are better positioned than others? Yeah, that's a good one. So I would go back to packaged food and meat, some of the names that Arun highlighted. Arun has a positive outlook over the next 12 months on performance for that sub-industry. He also has a positive outlook on the household products sub-industry. And if you look back, those are really the two sub-industries that overall, performed the best, both back in 2008 and during the 2001-2002 recession. As far as my coverage in consumer staples, I like the hypermarkets and super centers a lot. Have buys on both Walmart and Costco. I like several of the beverage names, PepsiCo, Coca-Cola, Keurig Dr. Pepper, and I also like in tobacco, I like Philip Morris here, one of the highest dividend yields in the entire sector. So, I think, if history is any guide, and of course there's no guarantee that past performance will be an indicator of future results, but you can go back to that slide, which I think was slide 18, and look at how the different sub-industries performed during each of the last two recessions. Okay, Arun, one for you here. Due to the potential for meat shortages and rising meat prices, have sales of plant-based meat products increased recently?
Yeah, that's a good question. Yeah, we believe sales have increased, but it's difficult to tell the extent of the increase, because the data that we receive also shows sales growth from increased distribution. So, the industry, the entire plant-based meat industry, they're rapidly expanding into new retail outlets. So the growth rates that we see, also include sales from new customers, as well as sales from existing distribution points. So we believe that sales of plant-based meat products have increased among existing customers, but it's just difficult to tell the extent of it, because the numbers that we see also bake in this increased distribution. I hope that answers that.
Okay, that's great. We have a couple related to Beyond Meat specifically. One client is noting the shares are down sharply this morning after McDonald's announced that they have no plans to, I guess, add Beyond Meat back to their menu. They were doing some trials in various markets in Canada, both late last year and earlier this year, but they've ended those trials and have announced they have no plans of continuing. Do you have any comment on that announcement?
Yeah. So this morning there was news of McDonald's ending its Beyond Meat burger trial in Canada with no plans to bring it back at this time. And this was a bit unexpected because Burger King, as many people know, has a plant-based burger option with Impossible Foods. But I'm not surprised that this happened at this time. Right now, quick service restaurants, including McDonald's, they're more focused on tackling their own challenges from COVID-19. So it doesn't really make sense to introduce more complexity to the supply chain if you don't need it, right? So and also, if this recession is prolonged, you won't see as many consumers trialing new products at quick service restaurants like you would see maybe during a stronger economy. So I can see why McDonald's stopped having its Beyond Meat product after this trial period ended. But then I wouldn't read too much into it because I think there's also a good chance that they could introduce it again in the future.
Okay, and then another follow-up question from a different client. Is Beyond Meat perhaps a takeover target longer term?
Yeah, yeah. I mean, we can definitely see that because, as everyone knows, they are one of the most powerful and largest pure play alternative meat companies out there with significant brand recognition, and just about every packaged food company is either planning or has already introduced their own plant-based product as well. So I can see maybe some of these larger packaged food companies, if their brand or product doesn't go according to plan, they can always consider acquiring a company like Beyond Meat. But I also see Beyond Meat's valuation is pretty stretched at this moment. So I don't see a company coming in at this time to acquire it.
Sure, and you talked about your sell recommendation, and which is a 12-month view on Beyond Meat. So, okay, one other question. This relates to Tyson. With plant production back up to 95% and the food industry starting to recover, do you think it's a good time to buy Tyson with the stock trading at a historically low valuation? What would be a near-term catalyst for higher prices? And I think you covered this on, pretty extensively on slides 46 and 47, and the reasons behind your strong buy. But I don't know if you had anything else to add.
Yeah. I mean, in short term, what I think was driving the stock a lot is a lot of negative sentiment on the impact of the plant closures, some of the issues with worker safety, and the risk of additional plant closures in the future. But right now, I think the risk of additional plant closures in the future is low. And as economies, local economies begin to reopen, food service demand is going to gradually improve, especially among quick service restaurants, which Tyson Foods is more exposed to. So I see them rebounding rather quickly. But then I think the largest catalyst, at least over the next 12 months, or even longer, is this impact from African swine fever. I mean, this outbreak began in August 2018, and since then, every single quarter we've been just waiting to see when export sales start to just explode and grow. But it's been taking a little longer than expected. One, in 2018 and 2019, China had plenty of meat reserves, so they were depleting their reserves before looking to export markets. And then coronavirus hit, so that also complicated things. But I think later this year and especially early next year, we can definitely start to see export sales rise.
Okay, great. We are right at the top of the hour now, so some really great questions there, and please feel free to follow up with us on any questions that we didn't get to. We'd be happy to help. One last thing I wanted to highlight on this final slide is 2 weeks from today, we'll host CFRA's 2020 mid-year review and outlook, benefiting from the better than expected bounce. That will be hosted by Sam Stovall, Todd Rosenbluth, and Tuna Imobi on Thursday, July 9th. And then on July 20th, we have another webinar, Generating Income in Q3 2020. and beyond. But please visit the links at the bottom of this slide for all of our recent and upcoming webinars, and also more information on the industries and individual companies that we discussed on the call today. So with that, thank you very much for your time. We appreciate your support of our efforts, and have a good day. Thank you.
Thanks, everybody.